Have you ever wondered why mortgage rates keep climbing, even when the Fed says they're controlling the interest rates? I bet you have, because I get this exact same question from many of my clients looking to move to or invest in the Gulf Shores, Orange Beach, Alabama area. Today, why don't we spend a few minutes working to uncover what is the real story and how it affects your ability to buy your next home or investment property? To do so, let's briefly take a deeper look at two topics. First, how mortgage rates affect overall housing affordability. And second, the roles that bond investors and the Federal Reserve actually play in shaping those rates. Let's begin by defining mortgage rates. These are simply the interest rates borrowers pay to lenders for loans on a home or an investment property. Mortgage rates significantly influence the real estate market by affecting how much payment a home buyer can afford each month and whether or not an investment property will produce an acceptable rate of return on a potential rental property. For example, let's say you're buying a $500,000 home or investment property with a 20% down payment. At a 3% interest rate, your monthly payment of principal and interest is $1,686. But if the rate increases to 7%, that payment jumps to $2,661. That's an extra $975 every month for the same property. With increases like that, it's easy to see why Gulf Shores and Orange Beach island-based sales volume was down almost 50% when comparing 2021 to 2024. So how do bond investors fit into this puzzle? And what are they doing to drive mortgage rates? Mortgage rates are actually closely tied to the yield on our 10-year Treasury bond. Why is this, you ask? Well, it's because mortgage rates are considered long-term investments by the banks and the brokerages issuing them. And investors look to that 10-year Treasury as the benchmark for safe returns on long-term investments. As a result, when bond yields rise, the mortgage rates typically follow due to the average 1.8 to 2.8 percentage point spread between what is considered a risk-free investment in the 10-year Treasury bond and the slightly more risky 15 or 30-year mortgage loan. The next question we need to ask ourselves is, why do bond yields rise in the first place? Well, there are a couple of well-known reasons. One, inflation expectations. When higher inflation begins to erode bond returns, investors start to demand higher yields. And two is the risk appetite of those same investors. During economic uncertainty, investors may prefer safe bonds, and that higher demand would cause yields to fall. Conversely, in strong economies, as investors move money to riskier assets with potential higher returns, the demand for bonds begin to fall, pushing yields up. For example, let's think back to 2022. Bond yields rose sharply that year as investors anticipated prolonged inflation, and they began moving money into assets that were considered a better hedge against inflation. As a result, mortgage rates quickly followed suit, jumping from around 3% to over 7% in less than 1 year. And why does all this matter to home buyers and investors? If mortgage rates rise due to bond market activity, housing quickly becomes less affordable. Regardless of what the Fed is doing, this can significantly reduce the budget of a potential home buyer and drive down the return on investment of rental property, which makes timing your home or investment property purchase super critical. Some advice for buyers. Focus on your budget or target percentage return on investment. Calculate how much you can comfortably afford at current rates and lock in those rates whenever possible. If you're shopping for a home or your next investment property, consider locking in a rate early, especially in volatile markets like we've had in the last few years. To recap, today we looked a little deeper at what ultimately affects mortgage rates, how they depend more on bond investors than the Fed, and why this matters for your ability to afford a home or investment property. If you're thinking of buying or selling, feel free to give me a call or shoot me a text and let's strategize together. Timing the real estate market has always been a difficult task, and rarely is it done to perfection. However, working with an agent in your market that stays on top of current market trends and what really affects affordability and return on investment is a big step in the right direction for any buyer or seller. If you're interested in learning more about South Baldwin County, Alabama, feel free to contact me anytime with questions, and let's work together to navigate this market with confidence.